Alex J. Pollock is a distinguished senior fellow of finance, insurance, and trade at Washington's R Street Institute. He told One American News the Federal Reserve would not survive the same stress test it gives U.S. banks because its own assets are dwarfed by its losses from a program called quantitative easing.
A really ironic thing to think about is what would happen if the Federal Reserve did such a stress test on itself.
The Fed's stress tests examine how a bank's portfolio would perform if economic conditions change dramatically. For example, if a bank lent money to gold mines and the price of gold collapsed.
Given its $4 trillion portfolio of very long mortgage securities and very long bonds, this makes it quite extremely vulnerable to increases in interest rates.
The author of the book, Finance and Philosophy, Why We're Always Surprised, said in the aftermath of the 2008 financial crisis, the Federal Reserve embarked on a program called quantitative easing, by which it printed money to purchase housing and corporate bonds. The goal of QE was to stabilize security markets and pump liquidity into an economic system that had stopped moving. Now the Fed is sitting on a huge position of these assets, and if markets move the wrong way, such as a rise in interest rates, the losses would be enormous, said the former CEO of the Federal Home Loan Bank of Chicago.
For each 1% that interest rates rise, the economic value or the price of the Fed's portfolio of bonds will go down by $200 billion.
When the Fed stress tests a bank, it relies on mark-to-market analysis, which means that assets are valued based on current market prices, not the purchase price. Pollock said in its official filings, the central bank has already acknowledged that it is bankrupt by the standards used for other banks.
They had a mark-to-market loss on their bonds and mortgage securities that they bought in so-called quantitative easing, that the mark-to-market loss was $66 billion. And since they have a capital of only about $39 billion.
Of course, the Federal Reserve is not a real bank, and the only thing it needs to pay off its debts is its own currency. So it can keep going until nobody wants its dollars anymore.
What are dollar bills? They're a note of the Federal Reserve. If you want to cash in your Federal Reserve note, say a $20 bill, they can give you 2 10s.
In the last Congress, Speaker Paul Ryan blocked a floor vote on Kentucky GOP Congressman Thomas Massey's Audit the Fed bill. But Massey refiled the bill on the first day of this new session, and it already has 54 co-sponsors. Neil W. McCabe, One American News, Washington.
Want to see more videos like this? Click on the link below and subscribe to One American News on YouTube, and call your cable provider and kindly demand that One American News is added to your lineup. Call and subscribe today.